Welcome everybody to which is now the third, I think, of the 4 live events that I'm hosting around managing your credit. So these Facebook Lives are really about learning to understanding the difference between good debt and bad debt, good credit, bad credit, and making the most of how to access finance. We all want to, at some stage in our lives, we're going to have to access finance, whether it's buying our first house, car, even if we need a personal loan, we're going to need to be able to access finance somehow. We need to know how to do that. And so this is really part of a campaign that is actually Capitec's running around, it's called a credit boot camp, and they're really educating people out there about credit. So their campaign has got the hashtag Living Better Starts With. And this is about sharing your goals. So those of you who are here today, I want you to go and share with me, what is it that your goal is? What is it that's going to change your life? Living better starts with. It could be, getting ready to buy my first home, buying a car, paying off my credit card, having enough money to educate my kids, starting an education fund. And I want you to pop that in the comments section, because at the end of today, or at the end of this session, I'm going to give away a copy of my book. It's called Money Questions Answered. This is actually a book that I put together of all the questions that I've been asked over the last 15, 16 years by all of you. When you ask me questions, I think, okay, let me answer that. And it's all in this book. So I must tell you the amount of questions I get, and I do try and answer everyone's questions individually, but most of it is actually in this book. So whoever wins this book today, your questions, money questions, will all be answered. But not only will you stand a chance to win a copy of my book, but Capitec has put together a grand prize of 10,000 Rand that they're going to give to somebody over the course of this month that will go towards your goal. So if you're the winner, you'll be able to use that 10,000 Rand to start that goal, that Living Better Starts With goal. And you also get a one-on-one session with me, an hour-long session with me. And if any of you who have contacted me before and asked me if I do give financial advice, I don't. I just cannot fit it in to my really busy schedule. So this is actually quite an unusual opportunity. And so hopefully that will help you, and I will be able to sit with you and see how can we achieve those goals that you've laid out in this series. So in order to win the grand prize of 10,000 Rand, you need to be watching these live events. But you also need to be sharing your goals. You can share them here, but you can also share them on social media with that hashtag Living Better Starts With. But please, if you are doing it on other channels like Twitter or Instagram, make sure you include my handle @MayaOnMoney so we can track it back to the specific campaign. Please also sign up for the Capitec Credit Bootcamp emails. So these are emails that I also worked with Capitec to make sure that we're giving some good educational information out there about how to manage your credit. So please also sign up for that. The link should be in the comment section there on my Facebook page. Now, on to the topic of today, which is about interest rates, because interest rates are all about the cost of borrowing. Very, very important. We can talk, if you want to, about interest rates when you deposit money, but obviously being a talk about credit, this is when we borrow money. And interest is what we pay for the cost of borrowing. So when I saw the interest rates being cut this year, so we had these massive interest rate cuts this year, I got so many questions from people about interest rates. And I realized that, this is not stuff that's taught at school. Of course, we all should be learning this at school, but people just don't even understand how interest rates work. So I wanted to take you through some kind of the questions and things that I was picking up, and hopefully that will answer some of your questions. But of course, we're going to have a nice interactive Q&A at the end of this presentation. I just want to start off with, please remember, by the way, to post your Living Better Starts With hashtags in here. But I want to quickly kick off with a little bit of jargon busting. So I just want to share my screen with you. Of course, let me try and push the right button. So you'll see here is my jargon busting slide. And this is what I found people were really confused about, especially when it comes to their credit agreements. It's like, which interest rate applies to me and what are all these different interest rates? So let's just start off. The repo rate. You'll have heard about the repo rate. The repo rate is the rate at which the South African Reserve Bank lends money to the banks as lender of last resort. So they can actually force the banks. They create what they call a liquidity squeeze in the market, and they force the banks to borrow from them. And they use this mechanism to set the interest rates for the country. And in fact, today, the Monetary Policy Committee met at the Reserve Bank. I think I've been waiting to hear the outcome, but I think they decided not to cut rates, to keep it the same. But the Reserve Bank get together and they decide what the interest rate should be for the country. Currently, it's 3.5%. It was 6.5% in January. So what they do is they will say, what's happening in the economy? Is the economy overheating? Are prices going up too quickly? Are people borrowing too much money, spending too much money? Because that leads to inflation. And when we have inflation, it means the prices rise so quickly that we all are poorer. Okay, we interest rates, inflation, we all know inflation, we all feel inflation. We go to buy something, it was a lot more expensive this year than it was last year. That's inflation. And it's one of the ways that the Reserve Bank can control inflation in the economy. It's called monetary policy, and they do this through the repo rate. So obviously what happened was when the economy imploded because of lockdown, the Reserve Bank thought, right, what we need to do, instead of we're not worrying about inflation anymore, we're actually worried about job losses, we're worried about boosting the economy. So they rapidly cut interest rates so that it made it cheaper for people to borrow. So first of all, it put more cash in our hands. If we were borrowing money, say for our homes or our cars, we got a lower interest rate. So it meant that we had a little bit more disposable income that we could spend, or if we'd lost our jobs, obviously we didn't have to pay so much for our interest. But it also encouraged people to borrow. And it's been very interesting because I've definitely noticed an increase in the interest for buying homes. People are saying, wow, home loans have become so much more affordable now that the interest rates have gone down. So that is really what the Reserve Bank is trying to do when it manipulates this repo rate. Then you will see something called the prime lending rate. And the prime lending rate is actually set at 3.5 percentage points above the repo rate. So currently the repo rate is 3.5%. Add 3.5% onto it, you've got 7%. And this mechanism was actually put in place, interestingly enough, when Tito Mboweni was the Reserve Bank Governor of South Africa. And he said, we want to have a fixed rate so that when we manipulate the repo rate, we know exactly what that prime lending rate is going to be. And the prime lending rate is what the banks use as a benchmark to lend to their customers. And this is a risk benchmark as well for them. So and prime kind of is like your prime cut of beef, it's the best cut. So if you are a prime customer, it means that you are a good risk customer. So you can expect to get the prime interest rate. This is particularly relevant when it comes to buying a home. You're kind of trying to get the prime rate because a home is quite a low risk, relatively low risk for the banks because there is an asset back behind it. So they know that, if you can't pay, they can take your houses. They don't want to do that, but there is an asset backing it. So it's a relatively low risk. And if you are a good customer, if you've got a good credit record, we'll talk a little bit about getting your credit record right in the next session. But if you're a good credit risk, you could get prime or even below prime for your home. And just to put it in context, that prime lending rate was 10% in January. So it's actually come down 30%, which is why, of course, people who had home loans especially are feeling a real uptick in the amount of money they have left in their pocket. And the other interest rate that I wanted to mention to you is JIBAR. So this is a little bit technical, but this is the Johannesburg Interbank average rate. And this is actually the rate that the banks lend to each other at. So remember, the banks don't always go to the Reserve Bank to borrow. They will borrow and move money between each other. So if they need liquidity, and that rate actually tends to be a little bit above the repo rate. It floats differently to the repo rate. It has a lot more to do with demands for liquidity in the market. But the reason I'm mentioning JIBAR is that, if you may know, Capitec actually launched its home loans a couple of weeks ago, which is part of the series, and they use SA Home Loans as their lender, and SA Home Loans uses the JIBAR rate. when they determine your interest. So when you get your contract, whether it is a home loan, a car finance, a personal loan, there may be some information in there that you need to look at. It could say this is linked to the repo rate, or it could say it is linked to the prime lending rate, or it could say it is linked to the JIBAR rate. So whatever rate, however that rate moves, and remember the repo rate and prime lending rate would be moving anyway together. JIBAR will be slightly different, but those two will be moving together. You know that your interest is a percentage or is fixed to that rate. So very important to look at your contract and understand what is the actual underpinning my interest. What is the benchmark interest rate that I'm using? And then it's important to understand the maximum rate that a lender is allowed to charge you. Because under the National Credit Act, it is actually quite specific about the maximum rate that a lender can charge. So I'm just going to quickly scroll through these and not having to scroll. So your personal loans are set at 21% above the repo rate. So the most you can be charged is 21% plus the repo rate. The repo rate at the moment is 3.5%. So right now, the maximum a personal loan can charge you is 24.5%. A credit card is fixed at 14% above the repo rate. So that would be currently 17.5%. Important to understand that what we call microloans or short-term loans, the loans below of 6 months or less, can actually charge 5% a month, because they charge on a month-to-month basis, not an annual basis. So if you keep rolling over those short-term loans, you could actually end up spending about 30% on your interest bill. So just very important to understand that. And your mortgages are also set at 12% above the repo rate. So right now, the maximum you could be charged is 15.5%. Now, remember, I'm talking about maximum here. So I'm not talking about what you could, if you're a good customer with a good credit record, you hopefully you're getting less than that. But certainly there's not much more a bank is allowed to charge than that. So now back to having a look at your questions. I see quite a few of your questions are coming in here. Oh, wow, Martin. Paying off his credit card. Thanks, Maya. After your guide last week, my goal to pay on my credit card, my personal loan, I got an unexpected lump sum. I resisted the urge to splurge and transferred to my credit card. Excellent, Martin. It's fantastic. I must tell you something. Okay, I want to share this with you. I don't know if any of you have followed the money makeover journey that I do every year. I'm going to be starting my 5th one in January, so watch out for that if you want to sign up for it. But we take 6 people through a financial rehabilitation. And what I've noticed is that every single time when people have committed to a goal, they achieve it. And what they also find is that money suddenly arrives. And I don't know what it is. Maybe it's like something spiritual or just some kind of powerful thing. But I do believe that money comes where it is respected and where it knows it's going to be treated properly. So I promise you, if you set goals and you stick and you have discipline, you will see your finances turning around. Now, getting back quickly to the interest rate story, I wanted to just cover some of the questions that I received during the interest rate cuts. So that just to help a little bit you guys when it comes to these interest rate changes as to how it actually affects you. So one of the most common questions I got was, when there's an interest rate cut, how quickly do the banks cut my mortgage rate? Like, do I immediately pay less? And actually, yes, you do. The banks will immediately, on that day, drop, because remember, your rate is a contractual agreement. Your rate is linked to, whether it's a repo rate or prime rate, it is linked to it. So if that goes down, they have to immediately reduce it. It may not be quite apparent on your statement because it'll only reflect on your statement at the end of the month, but you will have had a pro rata cut during the course of the month. And the other question I get so much with the interest rates was, especially on home loans, is this the time to start cutting interest rates? I mean, not to cut interest rate, to fix my interest rate. Because now, especially when I'm buying a home, the interest rates are so low, we know that they are most likely to go up from here, not down. So as the economy recovers, as everyone goes back to work, as inflation enters the system, we're expecting interest rates to increase again. Maybe we'll get another cut before the end of the year, who knows? But generally speaking, within the next 2 years, economists expect rates to start increasing again. So why don't I lock in now to this really low rate on my home loan? The problem is it doesn't actually work like that, because what the banks actually do is they say, well, if you want to fix your rate, and you can never really fix your rate for more than 2 or 3 years, by the way, you can never fix it for 20 years. They'll let you fix it for 2 or 3 years. Then they're going to say, well, you can fix it for the next 2 or 3 years, but because we're predicting an interest rate increase, we will actually fix it at a higher rate than you are currently paying at the moment. So right off the bat, you start paying a little bit extra into interest that you wouldn't be paying if you didn't fix it. So my recommendation is not to go and choose a fixed interest rate at the moment. I would rather say, if you're looking to buy a home or even any financing, look and say, what if rates went up by 2%? What would my installment be then? So say that increased, I'll take a random, say your installment was 10,000 Rand. Now that would make it 10,200 Rand. Start now paying 10,200 Rand, so that you know that when those rates go up, you can actually absorb those increases because you were already paying it. And whilst those rates remain low, you are actually effectively paying extra into your mortgage or into whatever financing you have at the moment. So I think racing off and fixing your interest rate, unfortunately, it doesn't actually work that well. The other point I wanted to make is that unfortunately, what a lot of people found, especially on car finance and personal loans, which tend to have fixed term rates. So often if you buy a car, they will say, we're going to fix your interest rate for the full 5 years. Or in a personal loan, we're going to have a fixed rate for 3 years. That gives you some security to know that your monthly installments will always be the same. But when the interest rates came down so aggressively, people were like, but it's not fair. I fixed this, but the rates have come down so much, I'm losing out big time. And the problem is you can't unwind that fixing, because if you go and you went to the bank and you said, I want to deposit money for 5 years, they've guaranteed that interest. They will say, we guarantee you whatever it was, 10% per annum for the next 5 years. And if rates fall, we will still give you that 10%. And they basically align that to any fixed interest rates they have with borrowers. So they can't do it both ways. They can't say to depositors, your interest rate is guaranteed, but then say to borrowers, don't worry, we'll cut your interest rate even though you've agreed to fix it. So it is very much borrowing and lending is very much part, and borrowing and depositing is very much part of the different sides of the same coin. So unfortunately, if you did fix your rates before the rate cuts, you did not benefit from those rate cuts. And the other thing that I picked up was that if, say, for example, you'd entered a contract, and even though perhaps your personal loan is now above the maximum that the National Credit Act allows, because you entered that agreement before the cuts, you still will be paying the higher rate. So unfortunately, for those of you who had fixed rates, this hasn't been kind of the bonus that it would have been for other people. And the other thing I wanted to just mention as well, another question I got from people was, how do I use the lower interest rates to pay off my loans quicker? And this is very simple. Just keep paying what you were paying in January. Before we saw all of those rate cuts, whatever your installment was, keep up those installments, because if you can still afford them, of course, if you weren't affected by COVID, because effectively you could afford them then. If you can still afford them now, it just means that you are paying in more capital and paying off those loans quicker. So that's just really some of the couple of tips I wanted to give you that I found useful, and the kind of questions I was getting through. But I now want to really get to your questions that you have all guys have been posting. Let's see. Okay, so I'm enjoying some of your goals. Paying off my car and investing for my child's education. That's fantastic. Yeah, investing for your children's education. That's, it's interesting. Those are the sorts of things that really, really do pay dividends over time, education. And it's probably one of the things that I think is a good thing. Student debt, student loans are actually one of those things that move you forward, as long as, of course, you understand them and you repay them and all the rest. But obviously much better if you can save towards your child's education. I've started paying off my smallest debt by adding R1,000 extra on my monthly repayments. My goal is to be debt free and start saving for an emergency account. That's fantastic, seller. And that's that snowball effect. In fact, in my book, I talk about that snowball effect where you also, what you can do is you take just one. So offset maybe with 5 debts, choose the smallest one, put as much as you can into that, close it quickly, and then take all the money you were paying into that to the next debt and the next debt and the next debt. It works really, really effectively. How do I go, Martin? How do I go about getting the interest reduction to actually pay off my balloon payment? Oh, Martin, I've actually written an entire article on how to pay off your car sooner. I had to go back like 4 times to the banks to make sure I understood it, because each bank had such a different response. It is incredibly challenging to understand. And it actually, Martin, depends which bank you're with. So just for example, if you're paying an extra, you're with ABSA, you could request ABSA to offset that against your balloon payment. So you could actually instruct ABSA to say, if, say, for example, you had a lump sum and you put it in, you could say to ABSA, please allocate that to my balloon payment. Westbank says no. Westbank says you would have to pay the installment capital off first before it can be allocated to the balloon payment. So just, you do need to find out from the bank how it's treated. Wendy, does South Africa have enough gold in stock to back up the money in circulation? No, we left the gold standard like the rest of the world in 1976. So there's another whole economic lesson in that. We don't use the gold standard. So this is one of the big arguments about why there is such inflation in the world. When you have paid off your home loan and you have an access facility, are you able to keep this access facility open? Absolutely, you can. And it's a very, very useful thing to keep open. You pay your, I think, remember, if you were with me last week, you will know that the facility fee is about 69 Rand, including that's with that. And you pay your 69 Rand to keep the facility open, and you can access the whatever amount that you're allowed to borrow on your home loan if you've paid it off sooner than obviously in the period. So absolutely you can, but only if you've paid your house off in advance. So if you've taken 20 years to pay off your house, there wouldn't be a credit available at the end of the period due to amortization. But I'm just wondering if Marlene, my social media manager, can quickly Google the article I did on that, because it is a little bit complicated. It is, I think it was something like, how does your access bond work or something like that. So maybe she'll post that link up. Carol, I'm in my 30s. I don't own any credit cards, and I would like to keep it that way. My financial goal is to increase my emergency saving to at least 2 months' salary. So, one of the ways not to have a credit card is to have the emergency fund, because often we use our credit card as an emergency. That's what we think of it. So when I say to people, what would you do in case of emergency? They say, I'd use my credit card. So that is absolutely a good trade-off. The only thing I would say about credit cards is that they can be very useful things to build up your credit record if used correctly. If you are like me, I promise you, I do have a bag of biscuits in my house right now, and I'm eating them nonstop, and they're going to be finished very soon because I cannot have biscuits in my house. I have a real weak spot for biscuits. Some people are like that with credit cards. They're like, I've got a credit card, I'm going to blow it out, I just shouldn't have one. If you're that kind of person, not a great idea. Or you could have a credit card and keep the credit limit really low at maybe 1,000 Rand a month. You can have a credit card for just 1,000 Rand a month. You can just instruct the bank to make that your limit. And then you spend on it, and you know that you can pay it off in full at the end of the month. It may be very specific. It may be only used for groceries, for example, but I pay it off at the end of the month using the interest-free period. And then that helps build up a credit record for me over time. So that is one way to use a credit card to build up your credit record without getting into difficulty. What is the difference between single interest, amortization, and how do each affect my loan? Okay, Labata, those are two very different. Amortization, simple interest are very, very different. So what I will do is I'll explain to you. First of all, interest. When you borrow money, interest compounds daily. I I wish I had the slide ready to do that. I actually did a presentation with it, and it's quite incredible the difference it makes when you compound daily versus monthly. When you deposit money, it compounds monthly. When you borrow money, it compounds daily. So that means every single day, a tiny little bit of more interest is added and compounds, which is why they often say even if you pay off you pay 2 days earlier on your home loan, for example, it can make a difference. Obviously it's minuscule, but over time that could really make a difference. So that is daily compounded. Simple interest is when it doesn't compound. And I don't think there's any examples anywhere in the world of anyone lending to you on a simple interest. Amortization. So amortization is very important to understand. Amortization is what I think confuses a lot of people. And if you want to go back to that first webinar I did on home loans, and I explained to you how the difference between what goes to capital and what goes to interest, that's a function of amortizations. Amortization is you take the whole loan and you divide the repayments with interest, so the loan plus interest, and you divide those into payments over the term of the loan. But although you're paying an equal amount, maybe 10,000 Rand a month, the amount that's going to interest, the amount that goes to capital differs. And you can imagine if you have a R1 million mortgage, in the first year, if you had 10% interest, your interest bill would be 100,000. Now, if your repayment is 10,000 Rand a month, that's only 120,000 for the year. So that means of that 120,000 you're paying back, 100,000 is going to interest and only 20 to capital. A couple of years later, maybe that your million is now only 500,000. Your interest would be 50,000. So of that 120 that you're paying every month, what would that be? 70,000 is going to capital and only 50,000 to interest. So that is how amortization works and why it's the more any extra Rand that you pay towards your mortgage or to any of your debt actually works really, really well for you because it pays off the capital and reduces the interest quicker. So that's where amortization comes in. I hope that isn't too complicated explanation to do on a Facebook Live event. But if you go back to the home loans one, I think we did explain it quite well. Thank you, Marlene. I see she's put up that link for how does my access bond work, which is also, by the way, explains amortization quite nicely. So you guys may want to pick up that article on my website. Wendy asks, if you have a store card and the minimum is 25 a month, but I can afford to pay 100 per month, how do I get handed over to lawyers if I forget to pay 1 month? Effectively, I'm ahead in my payments. Now it reflects badly on my credit record. So, Wendy, this is actually very interesting. I have picked this up. So it's about the way that some of the retailers actually look at, they actually look at your monthly payments and they don't look at advance payments as going towards your monthly payments. So yes, they've reduced your debt. So let me say, for example, say you owed 1,000 Rand. And instead of paying 25, you paid 100. That means you only owe 900 Rand. But it still means you have to pay the next installment. So maybe the next installment's lower. Maybe the next installment, instead of being 25 Rand, is 20 Rand. You still have to pay it. If you don't pay it, it's considered a missed payment. I have been speaking to the retailers about this. There's one in particular that I picked up complaints about. And they said, well, it's the way their system works. It's just, remember, they have millions of accounts and the computer works it that way. So basically, you can't build up a credit for your repayments on a store card. It just doesn't work like that. And in fact, even if you built up a credit on your home loan, for example, even if you were paying in advance, you would still need to instruct the bank, even car finance. Car finance, you can pay an extra, but if you perhaps hit a month or two that's bad, you would need to say to the bank, please pull on my advance payments. So you can't just not pay miss a payment. A missed payment will reflect on your credit record. Cindy, I want to buy my 11th house. 11th house? Whoa, Cindy. Whoa, you're a property mogul. Hey? Wow, 11 houses. I want to buy my 11th house, but this one is on a high amount. I'm still owing 5. Is it wise to settle all my bonds and apply again, or take this money and buy cash? Yeah, that's probably a difficult one, Cindy, for me to answer on this. But what I would like you to do, again, Marlene, maybe you can just find the link that where we did the article on. In fact, we did a great Facebook Live event on this topic of multiple property ownerships and how important it is to manage cash flow. So maybe we can get you, Cindy, some links to that. But it's probably a question I would take a little bit too long to answer. But one of the things is you do need to watch your cash flow when you're buying properties, and also just keep in mind that if you're renting out property and earning an income from it, it's taxable. But you can deduct the interest from your mortgage from that tax. So there's a lot of things going on there that you need to consider. Titambiso, should I close my credit card? I have enough emergency fund in my access bond. I opened an access bond after following my advice on my website. Well done. Thank you. Well done for following my advice. Well, I mentioned just now about where a credit card can be useful because it can help you with with your credit record. So it's to me, it depends. If you feel that you're somebody who's disciplined, you feel like you're not going to use your credit card, and you'll always make sure you pay your credit card at the end of the month. There's nothing wrong with having a credit card. There's a lot of advantages actually, because you do get an interest-free period if you pay it off in full at the end of the month. If you don't, the interest is actually charged from the day of purchase. People don't realize that. So, maybe if I was you, if I want to keep my credit card, I knew that I was a disciplined person, I could lock it away and just have it there. Maybe not a bad option. Or go and say, right, a little nervous that I may get carried away. I'll lower my limit, but still have it, and it adds to my credit history. So maybe something to think about. But absolutely, having that emergency fund is absolutely critical. Also, keep in mind, if you have your emergency fund and you face an emergency, you could, because the emergency is there right now, have to pay for it immediately with your credit card, and then you transfer the funds from your emergency fund into your credit card. So that is another way to also use your credit card in combination with your emergency fund. Let me see, what other questions are we getting through here? Please, guys, remember to put your Living Starts Better with hashtag. I just want to see if there's any questions I've missed, because we are coming up to past, which is when I normally sign off. So I think I've got through most of your questions, but I'm really excited to see so many of you. I see the same names coming back each week, and I'm really excited that a lot of you are starting to apply some of these things. And I do believe, people talk about discipline. They say, oh, well, people aren't disciplined. They're greedy. They're lazy. I think that a lot of our money management is we don't understand the impacts of it. We just don't realize it. I'm going to share with you when I do my next Facebook Live what happens when you only pay the minimum on your credit card. When I show you that, not one of you will ever in your life again pay only the minimum on your credit card. But I'm afraid you're going to have to wait 2 weeks for that, for the next one, because I'm going to be away next week. I have a break that I'd organized quite a long time ago. I'm really excited because it's the first time I've had a break since lockdown started. As you can imagine, for us journalists and financial educators, it's been hectic. So I'm going to be taking next week off. So the next Facebook Live is on the 3rd of December. So please join me then, because I'm going to be talking about just managing your personal debt, just in general, looking at things like credit cards, the impact of credit cards. So please join me then. Please bring all your questions. And it's been really fantastic. And remember, hashtag Living Better Starts With, share it across all your media platform, all your social media. Make sure you put my handle in, and also remember to sign up for that Capitec Credit Bootcamp as well. But thank you, guys. I've really enjoyed your questions, and I actually really enjoy these sessions. It just gives me an opportunity to connect with you and to perhaps share my knowledge, and hopefully give you all guys a lot better just financial education, so you can make better decisions. One last question. What are good debt books to read? Can I think about that? I mean, obviously my book's excellent. Marty, we can put up a link for my book. So I have a very good book, which is all about managing your debt and paying off debt. Off the top of my head, I'll need to think of a few other ones. But yeah, I'll think of that, Farrell, and we'll post some ideas up there. But thanks to everybody, and have a wonderful, wonderful evening. And when the weekend gets here, enjoy it as well.